developments in emerging market economies, and we will try to answer these questions. What factors have accounted for the solid performance of emerging market in the current global tightening cycle? What we mean by current global tightening cycle? As we covered until today, lots of developed economies with the leadership of the United States and Federal Reserve, they decreased their interest rate during the global COVID crisis, pandemics, right? COVID-19, during they decreased their interest rate, give lots of dollars and other liquidities to the market with the cheaper funding, lower interest rate. But after their inflation start to increase and converge their targeted level, they started this global tightening cycle. Global tightening means tapering process, meaning increase in the interest rate, okay, decrease in the global liquidity. So what factors have accounted for the solid performance of emerging market in the current economic cycle? What is the appropriate strategy for bringing inflation back to target? Because during the COVID crisis, inflation is below target, but right now it is above target. So this is a boom-bust cycle, and each developed market economies try to converge their actual inflation rate to their targeted inflation rate. So the third question that we try to cover is how should emerging market central banks respond to financial stresses that may pose a trade-off between achieving the price stability? Because sometimes we have other financial stability indicators like the credit growth rate, like the volatility in the exchange rate, right? Like the unemployment rate or the GDP growth. And sometimes when we are trying to achieve one of them, we have an opportunity cost, meaning that if I want to decrease the inflation rate, I will increase the unemployment rate. This have a payoff. Okay, there is no other possibility if you are not getting a positive supply side shock from the universe. And the last question is, how can the fiscal policy help in the fight against inflation? So not just the monetary policy, because if we are speaking about interest rate, Federal Reserve, these are all monetary policy issues. But we have lots of fiscal policy issues as well, like the tax rate, tax regulation, redistribution of the income. And these are the fiscal policy targets. Let's start the slides. As you see in the first slide, in the top, we have many emerging markets. Many emerging markets may help up well in environmentally abruptly rising global rates. And emerging markets tighten earlier and more aggressively than the advanced economies. What we mean by tighten their interest rate, because as you know, emerging market economies is a little bit more volatile. What we mean by more volatile? When we look at their exchange rate, when we look at their GDP growth, when we look at their financial stability indicators, they have a little bit volatile and increasing and decreasing more than the advanced economies. For that reason, as you see here, we start to global COVID crisis, as you see here. Deborah, could you close your voices? Okay, I did it. As you see in the left-hand side, in the first chart, as you see, we started to decrease the interest rate because of the COVID pandemic. And then we started to increase because of the inflation increase. We started to increase the interest rate to decrease the inflation. But as you see in the first slide, in the left-hand side, first graph, the United States start their tightening process as of December 21. But the emerging markets start approximately, as you see, 6 months before the advanced economies, as you see here. Okay, the emerging market tightened earlier and more aggressively because the shape of the line also showing how the aggressive the central banks while they are tightening their monetary policy. So if it is steeper, it is less aggressive. It is more flatter. It means that you are more aggressive while increasing the interest rate. And the right hand side saying that this emerging market tightened earlier more aggressively than advanced economies, which help keep capital outflows limited. What we mean by this? You are in South Africa, let's say, okay, or you are in Turkey, you are in China, you are in South Korea, you are in Brazil, you are in India. These are all emerging market economies, okay? While you are categorizing the world economies between advanced economies and the emerging market, when we drop the G7 or G8, remember the name: United States, Canada, Germany, United Kingdom, France, Italy, and Japan. Okay, and Australia, the last, G8. These are the most advanced economies in the world. But when we speak about like South Korea, like China, like Singapore, or like, let's say, Indonesia, Malaysia, or let's say, come to the African side, when we speak about South Africa or Tunisia, these are all emerging market economies. And what is the basic features of the emerging market economies? Their capital, their financial market is less developed, and they need capital inflow to sustain their investment target because their saving rate is really low. Let's say you wanna buy a house, okay? The house is $1 million, and if you have $300,000, you will get borrow from the market approximately $700,000, right? So you want to make an investment $1 million, but at your hand you have only your saving $300,000. So the gap between this $700,000 will be your borrowing from the banks, from the other people, from your father, from your mama, anyway. But these will be your borrowing. And Germany, in the next slides, maybe in the next chapter, I will try to show how the saving rates in the world and the advanced economies saving rate is really high. So they don't need any other country to give them borrowing, to give them money to sustain and to fulfill their investment levels. So like Germany, like United Kingdom, like France, they have enough money to make their investments. But Turkey, South Africa, Brazil, to make their infrastructure, for instance, their ways, their bridges, their hospitals, even those type of things, they need international money, okay? And this type of international money come to this country according to interest rate differences, interest rate spreads. If the Brazil interest rate is higher than the United States, the investor in the United States thinking this issue. If I put my money in the US banks, I will get 2% return. But if I put my money in the Brazil bank, I will get 10%. So increasing the interest rate in the advantage of the Brazil will bring the capital inflow to the Brazil from the United States. So if the emerging market economies, as you see, increase their interest rate more aggressively than the advanced economies, they will help their capital outflow limited because of the COVID crisis, lots of money, they don't like risk. They outflow from emerging market economies to their safe haven. What are their safe haven? Advanced economies, gold, cash, US dollar. These are the safe haven. If you see a risk in the market, the money return to their home country. But if you give them the higher interest rate, higher return, the outflow will be limited. So look at the right-hand side as you see. Global financial crisis, as you see here, the cumulative bond flows. What we mean by bond flow between the emerging market economies and the advanced economies. Okay, these are the bond flow between the countries. And on the left-hand side, in the chart, this is percentage of the initial allocation, the y-axis, and the weeks. How many weeks later the capital outflow will return back? And the Fed rate hike, as you see here, the global cumulative bond flow is negative. What we mean this? Emerging market economies, from emerging market economies, we are facing and experiencing lots of capital outflow. Okay, the money is going to the advanced economies because they are safe haven, less risky. And as you see here, improved credibility of the monetary policy frameworks has helped ease trade-off for central banks. Look at the left-hand side. Framework in emerging market economies improved markedly in the past 2 decades. As you see here in the 2000s, the blue line, first look at the blue line first. This is the inflation targeting countries. Okay, lots of countries in the world focusing on inflation targeting. What we mean by inflation targeting? Price stability. Okay, sustainable inflation level like 2%, 3%, not higher inflation rate. And the central bank transparency index, as you see. And the framework in the emerging market economies, as they targeted the inflation, their central bank transparency index is increasing. So the correlation between the central bank transparency and the inflation targeting is positively correlated. And as you see in the right-hand side, the second chart, which has helped improve the anchoring of expectation across the EMs. What we mean by expectation? Every month or every 1.5 months, the Federal Reserve Chair, the Powell, sit the desk and make a declaration and presentation to the rest of the world. While speaking, what is the main basic feature of that speak? It's this, forward guidance. Forward guidance means while speaking, the Federal Reserve Chair trying to adjust the expectation of the market according to the Fed. Fed is guiding to the market, okay, forwarding to the market. So market adjusting their all type of expectation according to Fed inflation targeting levels. Okay, so in the emerging market, Hassan, yes. I don't know, but one of the person has a background voice. I don't know who's that. Until the end of the session, I kindly request from all attendances to mute themselves. Then in the question and brainstorming session, I will let you to ask all your questions. And as I said, deviation of the, look at the right-hand side chart, deviation of the long-term forecast from the targeted level. What we mean by this? If you are a central bank, you try to forward the guidance of all the market expectation. So let's think this. Dr. Walchin has an investment, or let's say Debra or Hassan or Angela trying to make an investment decision in their own country. Okay, they will try to make a decision-making process. They have a money at their hand. They will try to decide whether they will buy gold, United States dollar, petroleum products, or washing machine and television in their home. They have 4 alternatives. They have money, and they will try to make a decision process. If Dr. Walchin or Angela or Hassan think that central bank will fight the inflation aggressively and the prices will go down in the next couple of months, central banks managing the expectation in a quick and in an achievement manner. Okay, central bank will achieve the inflation target. So the prices will decrease in next couple of months. Whether any type of these people will buy those television, gold, or United States dollar, no, because they know that prices will go down in the next few months, right? If you have an expectation in the next couple of months, the prices will go down, you will never buy something. You will wait until the 3 months passed and you will buy those things with a cheaper prices, right? So if the central banks will manage all the expectation in the market with a successive manner, this means that all the market participants, even the household, even the banks, even the financial market financial market participants will adjust all their demand and supply condition according to those expectation levels. And look at the left hand side in the third chart. As you see here, reduced financial vulnerabilities also contribute to the resilience of the emerging markets. So financial vulnerability generally happen in the crisis period, like the COVID crisis, like the Spain and Portugal or Greece crisis in the European Union, or the global financial crisis like the Lehman Brothers collapse in the United States in 2008. So if the reduced financial vulnerabilities we see, if the central banks take the necessary action to manage the capital outflow or the risky asset, this means that these financial vulnerabilities will decrease, and this will be contributed to resilience of emerging market output, because it is in its basic feature, the emerging market has less resilient, less robust. They have a little bit volatile. In any type of shocks, they can face a fixed depreciation, they can face a capital outflow, and they can face even the budget crisis. So these type of financial vulnerability issues, especially decrease in the financial vulnerabilities, will increase their resilience in terms of any type of supply or demand side shocks. And emerging market sectors are better capitalized, as you see in the 2008 crisis, in the left-hand side, first chart. The emerging market banking sector capitalization is approximately 12%, but right now it is approximately 16%, meaning that 50% higher. And in Latin American countries, it is approximately from 13% to 16%. So emerging market banking sector is taking the necessary action for any type of negative shocks in the financial market to make their resilience better. And reserves increased until the pandemic. What we mean by this reserves, for instance, I don't know which type of countries the people in this presentation working, but Dr. Walchin, are you in which country you are living right now?
US.
US, United States, perfect. So your country is not a good example, because United States money is a reserve money. So they don't need to collect the United States salary, because every country in the world trying to collect the United States salary, because your currency is a reserve currency. But let's say I'm in Turkey, and in Istanbul, the Turkish Central Bank need to United States dollar in our central bank to make the imports, right? So if I buy the Mercedes or BMW, or let's say Bosch or Siemens products from the Germany, whether the Germany accept payment in Turkish lira? No, because they will never accept those type of payment in Turkish lira or in local currency. They will accept those in euro, United States dollar, Canadian dollar, Australian dollar, Japanese yen, United Kingdom, pound sterling. So these are the reserve currency. And emerging markets, to make their imports successively, need the reserves in their central banks. They collecting reserves. And as you see here, until the crisis, their reserves resilience in the central banks of the emerging market economies, lots of countries, approximately 100 countries, their reserves is good. Reserve asset percentage of GDP, approximately 20%. But after the global financial crisis, it decreased approximately 32% till the 15%. But then until the COVID crisis, as you see, they increased their capital adequacy and reserve structure in their central bank in terms of other types of global currency. But as you see, after the COVID crisis again, they decreased to their average for the approximately 23 years. It is around here the 18%. And the financial market today remain optimistic about the inflation. What we mean by optimistic about the inflation? Optimistic mean, look at here, Here we have on the left-hand side, market expects inflation to follow relatively quickly, including the emerging market economies. And we are here. Okay. The United States in the light blue, here in 3.2% inflation. And the central and emerging market economies around 15%. But the Asia, as you see, because of the Singapore, Thailand, Japan economies and China, it's around just 1 or 2% inflation. But the next couple of years, until the end of 2000 or 2024, the inflation will converge its targeted level around 2% for all the central banks, even Latin America, Euro area, United States, central emerging market economies, or even Asia. And this will allow policy rates to fall to starting this year. What we mean by this? If all participants understand the inflation and interest rate relationship, you will understand the basic topics of all the issues here to cover. What we mean by this? When the inflation started to increase, all central banks increased their interest rate. Why? Because inflation generally increased because of the demand shock. If I give as a central bank to Dr. Walchin cheaper money with zero cost, Dr. Walchin thinks this. If I get from Dr. Dogan zero cost money, I can buy everything. I can go to any house in Miami. I can go to Canada to buy a summer house. I can buy even airplane because no cost in money. And if the interest rate is lower, inflation will go up because like the Dr. Walchin, everybody want to buy a house, want to buy a new car, want to buy a new airplane, want to buy a new washing machine. So if the interest rate, the cost of money is lower, inflation will go higher. Okay, because everybody wants to buy something. Then the central banks see this inflation increasing because the cost of money, interest rate is lower. Then they increase to their interest rate. Okay, they increase to their interest rate until the inflation rate. And when the Dr. Walchin or any parts of the world, any attendances here see that if I buy a house in the United States with $1 million, if I pay in return $2 million to the banks, I don't want to buy this because of this interest rate higher. I don't want to pay this cost of money. And nobody buy a new house because interest rate higher. And nobody buy a house, and house price, washing machine price, car price start to decrease, and inflation start to decrease. And because the inflation start to decrease, then I can decrease my interest rate gradually to the interest rate. These two charts showing this relationship to you. Here on the left-hand side, if the inflation converge their targeted level as of the 2024, then all central banks start to decrease on the right-hand side their inflation and their interest rate gradually. Okay, first the inflation start to decrease, then I will decrease my policy rate, central bank rates. Okay, let me look at here. There is a question here. Let me first answer this question. Why is China not among the developed economies? Perfect question. Good question. If you understand what we mean by developed, you will understand everything. What is the GDP of the China? It is approximately $17 trillion, right? But what is the GDP of the Luxembourg or Norway? It is just $1 trillion, right? So lots of attendances think that China is 17 times higher than the Luxembourg, right? Or Norway, because it is the second biggest economy in the world after the United States. But while we are speaking about developed economies, we are not speaking about the nominal GDP. We are speaking about the per capita GDP. Okay, people per person income, how it is. So in China, we have $17 trillion, but also we have 1.5 billion population. And Antonio, Could you mute yourself?
No. So continue, sir. Continue, Doctor. Sorry.
Okay, thanks. As I said, $17 trillion economy in China, but people in 1 year earn their approximately $10,000. But in United States, per person income is approximately $50,000. In Norway, it is $75,000. In Italy, it is approximately $40,000, but in Turkey, $8,000. So not the whole economy, but the per person, how it is earning the money, it is showing how you developed you are. Okay, so China is not a developed economy. Yes, it is trying to become a developed countries, but it has lots of ways to complete. Okay, lots of journey it's completed to become a developed market economies. And is that what is called petrodollar? Actually, Jonathan da Silva, I couldn't say this risky asset. Petrodollar, let me explain this issue, this phenomenon first. Petrodollar is after the Second World War, United States open a model. It is Bretton Woods model. Okay, Bretton Woods. Bretton Woods is a concept that shows us IMF, World Bank, and making all type of payment, making all type of issues, transaction with the rest of the world, even petrol, even gold, even any type of products in United States dollar. Okay, today I want to show you, let me stop this and I will share my screen, and because I took this screenshot today and I want to show that screen to you. Let me open it. Not this one, but this one. Look at this, please. I'm sharing my screen. Everybody can see here the blue line and orange line? Yes. And this orange line, okay, orange line on the left-hand side, it is showing share of payments around the world via SWIFT payment, share of the euro. It was around to 35%, but in 1 year, it decreased to 23%. Okay, only 20% payment making in euro. But as you see on the right-hand side with blue line, the United States dollar all around the world with all payments made approximately 48, meaning that 6 billion people, 190 countries, making their half of this, making their payments in United States dollar. If we have 6 billion population, 3 billion using United States. If we have 190 countries, approximately 100 countries, all of them making their payment in United States dollar. This is huge. Okay, and the petrodollar is this. If you are buying a petroleum products, you will make all payments in United States dollar, not in euro, not in ruble, not in Chinese yuan, or not in Great British pound. Petrodollar is a phenomenon built up after the Second World War with the power of the United States and with the introduction of the IMF and the World Bank. Okay, and let me turn my presentation back, Jonathan. And here we are, as you see, core inflation. What we mean by core inflation? Core inflation is this. We have a basket when we go to the supermarket. In the basket, we buy lots of things, right? Let's say Dr. Walchin go to the shopping, and today they took bread, water, and let's say similar things, cheese. These are the basic foods and basic needs of the human beings: bread, water, and these are core things. But if the Dr. Walchin go to also take a whiskey, this is not a core thing. If he does not drink the whiskey or drink the whiskey, he will continue to live, right? But without water, he will die. So he will buy all these type of things, especially water, bread, and necessary needs for human beings. These are the core inflation, core prices. And on the left-hand side, as you see, even in the 2023, the core inflation in emerging markets approximately 9%, and in the advanced economies, meaning the developed market, we have approximately 8 or 7% today, the inflation level. And services inflation has picked up markedly. What we mean by services inflation? Food inflation is easy to decrease. Let's say today the banana prices go up. Okay, this is the banana price, right? It is increasing. And let's say Antonia and Jonathan see that banana price is increasing, right? They will fill all the fields in the world with banana, because they suppose that because of the increase in prices of banana, they will get huge profit when they grow up the banana in the fields, in the jungles, right? But after they build up all the bananas and harvest, because of the supply increase, because they will bring lots of banana to the market, the banana price will start to decrease, right? And the food prices, energy prices can easily rise and decrease. They are volatile. But the services prices, like your wage, for instance, Dr. Walchin today, let's say, has an agreement with their university, and they have a salary, right? And after the inflation in the United States, next year, the university authority offered the Dr. Walchin an increase, let's say 5% according to their inflation level. But after the inflation decreased to 2%, university will never say that, Dr. Walchin, give my 2-3% money back. This will not happen, because this is a service, this is a wage, and this is a sticky prices. So if you go to the restaurant, the menu in front of your desk, if the price is higher for that, it will not decrease because of the services inflation. But the energy prices can easily be returned to their initial level. And the monetary policy strategy that we have here in the risk of inflation processes argues for maintaining these type of issues. Tight monetary policy. What we mean by tight monetary policy? Increase in the interest rate. And we are trying to decrease the inflation because of the tight monetary policy issues. And the several factors may help explain the sticky price inflation and pose upside inflation risk. And on the right-hand side, as you see, oil price shocks have a larger effect on consumer price index levels in emerging market economies, because lots of EM economies has a net importer of the oil products. And because of the oil products and exchange rate volatility, the increase in the oil price brings their consumer price index level has a higher level, because they are importing. Okay, they are importing the oil products. And this is a little bit mathematical, but I will give the basic perception for this. Risk management approach suggests that reacting aggressively to upside inflation surprises. As you see, the aggregate supplies curve here we have, and the targeting group push output down more today if inflation expected to persist. So meaning that if you try to decrease the inflation, your output, your GDP will also decrease. Okay, for the current gap. And after this, the output gap will decrease, then it will converge to its initial level. We are saying this hypothesis is overshooting hypothesis. We are giving a shock, it is decreasing, then it will converge its initial level. And as correcting for unexpected persistent inflation later is costly. So if the inflation is persistent, and if you postpone all type of necessary action to decrease those inflation levels, it will be higher cost for you to decrease those inflation in tomorrow. Okay, so you should take necessary action as soon as possible to fight the inflation and to fight in increase in prices. And the monetary policy and financial stresses, as you see here, emerging market economies may see heightening financial stress. As you know, even the Federal Reserve today offering the market participants 6% interest rate. Nobody put their money in Kenya, Tunisia, Algeria, or South Africa, or Turkey, or the Uzbekistan, because even the Federal Reserve, United States banks offer 6% of level interest rate. So financial stress is coming to the emerging market economies on the door. And additional tools may improve the trade-off, including the liquidity support or the emerging market economies a fixed depreciation, but should be used carefully and temporarily targeted, because volatility in inflation rate also brings the volatility in financial stresses and volatility in the exchange rate as well. And here, as you see, if the capital outflow and exchange rate pressure we face, this means that low FX mismatch and high FX mismatch. What we mean by this, if you have a deep FX market, your arbitrage condition will not allow to people to manipulate your FX market. All people will reach their equilibrium target, even the market makers, even the demander, or even the supplier. So if you have a deep FX market, it is okay. But if shallow FX market, if it is not deep, you have a vulnerability to get any type of positive or negative price shocks from the rest of the world. And the fiscal policy action, as you see on the fiscal tightening, can help cool inflation and reduce public debt. So if also additional to the monetary policy tightening, if we also targeted the fiscal tightening, then this will decrease our inflation and reduce our public debt as well, because fiscal tightening means that we try to increase the tax rate. So if the tax rate increase, we are tightening the fiscal rule, and the government will collect higher taxes because the increase in the tax rate. So monetary tightening should support it with the fiscal tightening to reduce the inflation collaboratively. So if you are tightening the monetary policy, but if you are expansionary fiscal policy, your price level and inflation target will not converge to central bank targeted level as well. And the fiscal expansion look like to boost the inflation and government debt, depending how the central bank responds. So as I said, if you are a fiscal expansion at this much, but if your monetary policy tightening at this much, the inflation also go down. But if your monetary policy tightening at this much and fiscal expansion as this much, even your monetary policy is a contractionary monetary policy, because of the expansionary fiscal policy, your inflation will go up, even the interest rate increase.